Okay, so trends. So we've already established that a trend can move in three different ways. You can either go uptrending, consolidating, or downtrending. All right. So we're up to the trend trading strategy part. So we want to work out how to actually use a trend to our advantage. So we've already said that, if we're in an uptrend, we're looking for buys. We're trying to catch the overall movement. If we're consolidating, we're waiting for price to break structure and work out where to go next. So not doing anything. And if we're downtrending, then we're trying to sell, trying to capture on those big moves, okay? And what you notice is that whenever price moves in a trend, okay, it creates what we call higher highs or higher lows. Okay, so for this example, this high that it previously made, okay, we have another higher high than that. So we have what we call a higher high. The highs higher than each other, okay? And the same thing for the low. So the low of that move, we have a higher low being made. So we have a higher high and we have a higher low. And the reason why I'm saying this is that sometimes we get it tricky to actually, or we have trouble trying to identify the trend, trying to identify what's going on. If we use this simple, pinpoint where the highs and the lows are, we can sort of identify it a bit clearer, okay? So as price continues to move up, as long as this low is higher than each other, we are still continuing the uptrend. And that's important because the second we stop creating these higher highs and higher lows, then the trend will reverse, okay? So let's say price gets to this level in the market here, okay? And then what we have is a same high. So instead of having a higher, so this is a higher high here. And then we have the same high. So the high wasn't higher than each other or wasn't lower, it was just the same as the previous one. Or what we can see, we can call this a double top. So prices came to an area twice and did not create a higher high. And then we can see, it might create another another same high. And then if price were to continue to trend and break out, then we can expect a continuation to the higher high. But instead it could come down and it could make a lower high, okay? The second we see the higher high and the lower high changed, we can expect the trend to change. Okay, so we have a lower high, and then we can even have a lower low because these are lower than each other. So on a high time frame, when we look for that area value and confluence, which is on a 4-hour time frame, we notice that we're trying to catch it, when price is making these lower highs, trying to make these actual these impulses to the upside. Okay, so we've got the correction, the impulse. Now on a lower time frame, this is what we look for the entry, this part here. So we're looking for the correction. So on a lower time frame, right, although these are higher highs, so higher lows being made, on a lower time frame, we're really just seeing this. Okay, and in order to actually catch the reversal and to catch a good break and retest and to catch a good entry, we need to wait for both the trends to line up on an entry time frame and on a high time frame. And how do we do that? We identify structure. We identify market structure of the high highs and high lows being made, and the lower lows and lower highs being made, and we work out what trend is about to reverse. Okay, so what does it look like on a high time frame or on an actual price chart? Okay, so we scroll down here. Quite simply, we have price making. This is a high high, a lower high, lower low, and another lower high. Okay, so we have a lower high, another lower high, another lower high, and a lower low. Another lower low. Okay, they're simply below each other. Now, as you can see, it could be this one doesn't really matter. Like nothing's perfect, but as long as we can pinpoint the overall trend. Okay. Now, from this area of value here, okay, because we're at a support level, maybe a trend line like that, we're looking to take a sell position, right? So if I jump down to my 50-minute time frame, this is the area of value. Okay. Now, moving towards the area of value, we have an uptrend. Even though we have a downtrend bias on a higher time frame, on the entry time frame, we have a movement to the upward, towards the actual support level, towards the area of value. Okay, and what you notice is that we have these formations of these lower highs and high lows being formed. Okay, now the second price gets to this level here, which is the actual area of value. What we notice is that price has the highs start to sort of shift. Okay, and this is where we can identify that the trend is changing. So naturally speaking, we try to catch a break and retest trade. So it could be an entry around this level here. But as long as we see that the lower lows and the higher lows are being made after the impulse, so after this uptrend toward the level, we can identify a good entry. Okay, so market structure always revolves around these lower highs, lower lows, high highs, and high lows. And on a high time frame, you notice them pretty clearly. On a lower time frame, even though we're trying to take a sell, we have to wait for this uptrend, okay, or this correction phase to be over. And how do we get the correction phase to be over? We identify our market structure and we wait for a reversal of it. Okay, and that looks exactly like this area here, where prices went from making up high highs and high lows to making lower lows and lower highs. And after I see, 1, 2, 3, maybe even 4 of it, I can say, okay, now I can look for a good entry because I know that the market's shifting, the trend's shifting, and how it's shifting, the sellers are taking over after the massive uptrend. Okay, that's the easiest way to identify trends, and that's how you use it on a higher time frame and a lower time frame to identify confluences.